Okay, let's look at the solution to this problem. And the first step of this problem was a request that you prepare a stockholders' equity section of a balance sheet given the information provided. One of the things you need to remember is that stockholders' equity is divided into two basic sections or categories. One is contributed capital and the other is retained earnings. Under contributed capital, in this particular business, apparently the company has distributed both common and preferred stock in exchange for owners' contributions. That needs to be distinguished also. If in fact preferred stock has been issued, because preferred stock has various preferences in terms of dividend distribution or even distributions in the event of liquidation or termination of the business, we typically will reflect the contributions associated with preferred stock first, listed first. And we'll show the preferred stock at its par value in this particular case for 10,000 shares or $500,000. The next thing that we'll show is any contributions at par value for the common stock. Common stock at 1 penny par value for 20,000 shares is the minimal amount of $200. Then we'll show also the paid-in capital in excess of par, first for preferred stock because of the preferences, and then for common stock. The amounts are reflected at $30,000 and $900,000 respectively. That gives us our total capital contributions by owners of the business. That's how much has been financed by the owners through their contributions in exchange for ownership. The other way that owners provide resources to the business is by allowing resources created through the operations of the business to be retained in the business. That amount is, well, they didn't actually give you this ending balance for the balance sheet here at the end of the year. They did give you retained earnings balance at the beginning of the year. And hopefully you remembered from prior lessons that retained earnings at the beginning of the year is affected by net income, increased by net income. In this case, that apparently was $50,000 for the year, less any dividends distributed for the year. The dividends amounted to $400,000, such that the ending balance of retained earnings was $775,000. I guess I blew that net income number there. Again, just checking to see if you're awake because I'm struggling to be awake. This is a very long lesson, and if you probably noticed my mistake there. I apologize. The net income was $550,000, not $50,000. Therefore, we had a net increase in retained earnings from the beginning to the end of the year, and it increased to $775,000. That is the amount that should be reflected in retained earnings on the balance sheet at the end of the year. The next question was, at what average price per share has the company's common stock been issued? And then also, what was the average price that the preferred stock has been issued? The solution to that problem is to note that the amount of total contributions on the common stock are the contributions at par value plus any paid in capital in excess of par value. That's how much has been contributed in exchange for stock. So the contribution per share is the total of those two divided by 20,000 shares, or $45.01 per share, apparently was the price at which the common stock was issued in exchange for cash when it was originally issued to the owners. As far as the preferred stock is concerned, again, how much has been contributed by the preferred shareholders was $500,000 of par value preferred stock, and then the amount in excess of par value was also contributed, or $30,000. The preferred stock shares numbered 10,000, so the actual contribution per share, or the price at which it was originally issued, must have been $53 per share. And finally the question, what was the amount of the dividend preference on the preferred stock? Well, the dividend preference amounts to $50,000. Actually, they ask you what was the percentage of the preference. If the dividends, preferred dividends for the year amounted to $50,000, and the value of the stock at par value was $500,000, then as a percentage of par value, 50,000 divided by the par value means that the dividend preference must be 10% of the par value.